G'day everyone and welcome to this ShareCafe Hidden Gems webinar. We're coming to you from a different venue today. I've had all sorts of internet problems sitting in town. Now, don't be afraid to ask questions today. We know that the feedback from CEOs at our presentation is that they love to get some questions from investors. So feel free to type in your questions in the green box provided. Nothing from me today in regards to the market. Recordings of all these webinars will be on ShareCafe and YouTube during the week, so look out for those. Okay, first up today we have Wellnex Life, ASX code WNX, market cap around $30 million, doesn't have a one-year return. The company is focused on the distribution of health and wellness products. We have with us George Karafotias, who is both the CEO and Managing Director. George, over to you. Thanks, mate.
Thanks, Tim, for having me today, and thank you for the opportunity to talk about Wellnex Life. Do you want to go down the next slide, Tim? Next slide. Yeah, so here at Wellnex, and we want to be an innovative Australian brand and distribution company that's going to specifically focus on the health and wellness market. But what makes us different is our unique business model and what we offer to the market. So next slide, Tim. So the key to our success is being first or fast to market with new innovative brands and products. And the way we do that is that we have an experienced team and also the contacts within the retailer network. So we're able to pick up customer trends and produce new products and brands that customers want and what retailers are demanding. And with our extensive manufacturing contacts, we're able to produce those products in as little as 3 months, where some of our competitors can take anything from 6 to 12 months to produce those products. So being first or fast to market is critical to our success. But underneath that as well, we have an extensive infrastructure. So we have an internal sales team, we have an internal marketing team, and we have a national field force team, which services over 2,000 pharmacy stores and 3,500 grocery stores. And that unique infrastructure underneath is critical for our success, not only just to get the product on shelf, but to ensure that consumers purchase that product. That we support the retailers, educate the retailers, so they can educate the consumer to purchase our product over others. So put all that business model together, and it's a very unique and advantageous model for the company. Next slide, Tim. We already have an extensive portfolio of brands and products in the market. I think it's over 15 currently, but I want to pick up on two brands specifically that shows what we do here as a business. And one is the Wagner Liquids brand. So we innovated here at Wellnex a new product, a new range of liquid analgesic range, soft gel. We took that product to Chemist Warehouse, and they were so excited about this new product innovation that they asked to joint venture that brand with Chemist Warehouse. So that product will be launched within Chemist Warehouse retail chain at the end of this month. So it's a really exciting launch. And the other one I want to mention quickly is the Iron Company. So again, that's Australia's first slow releasing iron gummy. That's secured ranging in over 2,000 pharmacy stores here in Australia, including Chemist Warehouse and API. And only last week we announced that that product will also go into the Coles supermarket chain. So again, that's just a sort of validates our business model in bringing new innovative products to market, then ensuring that those products are able to be retailed among the major players in the health and wellness market. Next slide, Tim. So we have relationships with these companies here on this slide represent about 90% of the health and wellness market here in Australia. And we have relationships with all these players, including some JV agreements, like I've mentioned with Chemist Warehouse. So what this does is when we bring a new brand to product to market, we're almost assured that we're going to achieve distribution. So that's really, really key. There's no point producing a product and not being able to sell that product through these retailer networks. Next slide, Tim. Look, there's no doubt the health and wellness market is the fastest growing market globally. I mean, one of the positives of COVID, saying that there is a positive, is that consumers' concentration on their health and wellness is only growing. So we're going to see continued acceleration of this market moving forward. And what that's really exciting is that both retailers and consumers are going to want new and innovative products to fill their shelves. So it's really, we're in the right place at the right time to grow this business. Next slide, Tim. Now, I can talk about our unique business model, but I think the figures speak for themselves. So this business has grown from about $6.7 million in financial year 18 to financial year 21, we did an $18.3 million revenue. Now, at the start of the year, we budgeted the revenue for this year to be about $21 million. Now, in the first 2 months, our revenue is up 49% compared to the prior corresponding period. So we're pretty sure not only are we going to do the 21, but we're actually going to beat it quite substantially. And the other thing I'll make a note is today we announced the Performance Inspire brand. Mark Wahlberg's Performance Inspire brand is going to be arranged in Chemist Warehouse, and sales from that brand aren't actually included in that $21 million figure. So we're very confident of the business moving forward. Next slide, Tim. So quickly, these are some key categories of focus that we want to focus on as a company. We are, some of our products are already in these segments, but one category I already want to focus on is the cannabis. So at the moment, we're working towards being one of the first companies to submit a TGA application to get an accredited medicinal cannabis product to market. That is a large market. If the rules around it have only changed this year, and we want to be one of the first players to have a TGA accredited medicinal cannabis product in the Australian market. So there will be some news coming out shortly about that particular category. Next slide, Tim. So the company is, while it's growing, is continuing to wanting to accelerate its growth even further. We're looking at bringing new brands and products to market. We're also looking possibly at acquiring some future brands that would accelerate our growth. And one particular focus we are really focusing on is the launch of an e-commerce platform. The growth of online sales, especially through this COVID period, has been enormous, and we want to take advantage of that. So in the new year, you'll see the company launching a new e-commerce platform for its current brands and future brands as well. We want to increase our joint ventures, build on the Chemist Warehouse relationship, look at some contract manufacturing work for some retailers and suppliers. And just a quick note on that, we have currently got 2 contract manufacturing agreements, one with a retailer and one with an Australian pharmaceutical company. We're currently looking at expanding that with an international pharmaceutical company for one of our products that we're currently producing. So that's really going to build on our revenue moving forward as well. So that's really exciting. Quickly about our distribution channels. 95% of our revenue comes from the Australian and New Zealand market. So there are opportunities for the business to grow internationally. So in the new year, we'll put some focus into growing our distribution channels internationally. Next slide, Tim. With any business, you need to have the right people in the right place. And I think at Wellnex, we've experienced a team with the right experiences to grow this business. Quickly, if you look at Georgia Sorotopoulos, she was general manager of the Big W Group, reported directly to the Woolworths board. Zach Bozanowski has been 35 years experience in the FMCG space, was a co-founder of Oost Vitamins, which earlier this year was sold to Procter & Gamble. And Vince Cadalda, our head of sales, has over 23 years experience in the FMCG space, including 15 years at Nestle as head of sales. So I believe that we have the right business model and the right team to drive this business forward, which is really exciting. Next slide. So in summary, we have a unique business model, a unique infrastructure that we've built within the business. We're in the right market at the right time. Our revenue and our numbers show that we are doing something right with our growth in revenue, and we're looking at continuing to accelerate our revenue moving forward and also our profitability as well. So on that note, I'll pass back to you, Tim.
Right, thanks, George. Quick question. Are you profitable? They're huge revenue numbers. When are you cash flow positive, and what does that look like?
Yeah, so at the moment, we're investing a lot of money into the brands and products that we're bringing out. We've got an aim to be profitable at the end of this financial year, so towards the last quarter of financial year 22. As we bring more brands and products to market, our GP margin will increase, which will accelerate our profitability sooner than later.
And can you talk a little bit more on international distribution? Is China a focus? I know there are obviously quite a few businesses targeting China with Australian, health products.
Yeah, there are, and everyone thinks China is the main market, and it is a large market. But our focus at the moment is firstly concentrating on the Australian market, but going international. And we've got a lot of focuses, not just China, but outside of China, which I think are easier markets to attack, including Vietnam. So we're getting first sales of our skincare brand into the Vietnamese market. With Chemist Warehouse as well, and the relationship we've built there, they're actually expanding into Europe. So they're actually in Ireland at the moment. They're expanding into the UK in the not too distant future. So that's giving us an easy access to some international markets. So China isn't our main focus. We think there's some complexities within that market. And I think there are easier markets to first enter into before we look at China.
And what sort of margins are you operating on, given, you've got a distribution in Chemist Warehouse? What are your margins on your product range?
Yeah, so depending on the product SKU, our skincare range anything from 45 to 60% margin. And nutritional dairy products, anything from 35 to 50% margin. So it really varies on the kind of product, but we will be aiming for a GP margin of around 45 to 50% across the whole group.
And COVID's always a question, but it looks like your revenue is growing. But the chemist, not every chemist is open, right? In Sydney, for example. So is the unlocking of the rest of the country a potential positive as well?
Yes, it is. But saying that, you look at our revenue growth in the first 2 months compared to last year. And I mean, I know there was COVID last year as well, but I think the lockdowns have been more severe, especially in New South Wales and Victoria. We're up 49%. So what you're seeing is that even though some chemists have shut down, they're one of the few stores that are open as well. So that people are going to chemist stores in greater numbers. But also what you have found is, for instance, Chemist Warehouse online platform is booming in sales. So people are, even though they might not be able to visit the stores, the actual traffic flow through the online channels into those stores is growing rapidly. And that's why we want to get into that e-commerce side, because that's just going to keep growing and growing moving forward.
And there's a question here, what percentage of your sales are through Chemist Warehouse? So it's a good question, actually. How much of your revenue comes from that particular partner and the others that you distribute through?
Yeah, at the moment, I'd say roughly around 40% of our revenue. And the rest is coming through API, which we've got significant arrangements through, and through the Coles and Woolworths channels, which we've got brands and products in there as well. We're going to make sure we're not Chemist Warehouse centric. We have got a wide distribution channels, as you can see from that previous slide. But also remembering Chemist Warehouse is a dominant player in this market, and you need them to keep growing your products. And they're one of the retailers that also take risks on new brands and products as well. So they're a very good partner to have to grow your business as well.
And do they white label their own products, Chemist Warehouse? Is that a potential risk for you if they go down that path, or is that potentially an opportunity where you can manufacture those products and white label them for them?
It's absolutely an opportunity. So we are currently doing some contract manufacturing work for Chemist Warehouse for one of their brands, for one of our products currently. For instance, the Wellnex Liquid G6 brand, now they did a 50-50 joint venture. Under that relationship, they pay for all the sales and marketing, which is the major cost of any brand and distribution company. So what they're doing is they're alerting the customer of this new innovative product, which then allows us to take that same product and put it into another brand, into other retail channels, to grow our sales. So we don't see it as a disadvantage. We think actually it's a positive for us as Chemist Warehouse, educate the consumer about new innovative products. We're able to use that marketing that they're doing to grow our brand in other retailer networks.
And just finally, on those revenue numbers, you said that you're not cash flow positive yet. Where do those costs come from? Where is your cost base?
Oh, the cost base is primarily in marketing. The cost base is primarily in running the sales team and the national field force team. The business itself, the Brand Solutions Australia business that we bought in July this year, as a standalone is profitable. Obviously, Wellnex has all the corporate costs and other costs associated with running a publicly listed company. I think by the end of this year, we will be profitable. We don't have to increase our revenue or our GP margins to cover the whole cost base of our business moving forward.
George, that's all we have time for. Have a nice weekend. Thanks for coming back. We'll see you again.
Thanks, Tim. Thanks for having me.
Next up, we have Tamboran Resources, ASX code TBN, market cap of around 235 million. The company's only just listed the last quarter, I believe, raising around $60 million. Now, the company has assets in the nationally significant Beadaloo Basin, which is in the Northern Territory. The company has a partnership with Santos and also has its own fully owned acreage in the basin. We have with us the Managing Director and CEO, Joel Riddle. Joel, over to you. Thanks, mate.
Thanks very much, Tim, and thank you for everyone joining this afternoon to hear about Tamboran Resources, which I think is one of the most exciting high-growth companies here in Australia over the next 3 to 5 years. If you go to the next slide, please. Look, starting out with a few highlights on the company. Obviously, energy security as a whole is very topical over the last few months, particularly over the last couple of weeks, with a lot of the gas crisis in the UK and even the government here in Australia really being proactive around addressing the emergence of shortfalls that are anticipated in the next 3 to 5 years. And where we see Tamboran fitting into that thematic is really being a solution to developing very prospective gas resources out of the Beadaloo Basin. Really 4 key elements of our strategy. The first, again, is very topical, is being one of the first net zero developers of gas here in Australia. We have a commitment as a company to be a net zero gas producer when we look at first production as early as 2025. We have a very focused strategy. Again, we're focused in the Beadaloo Basin with 2 primary assets, EP 136 and 161, where we have over 31 TCF of resource potential. This is a significant scale, and really the kind of scale it requires to really move the needle on energy here in Australia. Each of these 2 assets are positioned in an area we call the core Beadaloo. This is an area that I'll talk about a little bit later on. The deepest area of the basin, where in shale, which is where we're focused here, demonstrates the highest quality rocks in all of the basin. And to no surprise, this is where we have a lot of activity occurring this year. And really we anticipate flow test results in this core area of the basin over the next 3 months, where 3 big wells are being drilled by Santos and Origin, and really where our 100% working interest block is centered around EP 136. With success of this drilling, we anticipate Tamboran to be really in the driver's seat as a company to really be the first to develop the Beadaloo Basin as early as 2025. The 4th element of our story, if you turn to the next slide, is around the people involved. The people really have 2 key themes around our board and management. The first theme is this is the right people with the right kind of experience. Led by our chairman, Dick Stoneburner, has a deep understanding of shale development, having founded Petrohawk in the US with one of the prolific shale plays called the Eagle Ford Shale back in early 2008, and ultimately sold Petrohawk to BHP for over $12 billion and shortly thereafter in 2011. Fred Barrett, also on our board, again, pioneer of the shale business. So these guys have the right kind of experience as it relates to having the knowledge base to really be successful in early stage shale development. The other key theme that you see across all the people on our board management is we've been very successful in starting out in developing companies that hundreds of millions of dollars of market cap and generating multi-billions of dollars of shareholder wealth over the course of participating in each respective company. And we're looking to do the same here at Tamboran. Next slide. So a little bit about the Beadaloo Basin for everyone not familiar. This is a world-class shale basin. It's a gas potential for significant gas that could get developed in this basin over the next 5 to 10 years. We're talking about multiple TCF of gas potential. The normal size gas developments that you see traditionally onshore in Australia are around hundreds of BCF. So we're looking to develop multiple TCFs of gas. And there's about 30 wells that have been drilled in the basin to date. And what you see along those 30 wells is there's common characteristics as the most prolific, the biggest shale play in the world, and that's been developed in the US, called the Marcellus Shale. So you see a lot of the same characteristics in the Marcellus as you see in the Beadaloo, which really gives us, as being in the center of the basin, a lot of excitement. This is a gas that's very low carbon. This is gas that we've seen with CO2 levels of 2 to 3%. So it really positions the development of net zero gas development by offsetting that 2 to 3% CO2 as we get into development. And there's multiple commercial pathways to market. There's an existing pipeline operated by our partner Gemini that is the only pipeline connecting the Beadaloo Basin to the East Coast gas market. And so that's a pipeline that we're looking to access as it relates to our early aggressive commercialization strategy. If you go to the next slide. So as we zoom down into the basin, just to give a little bit more color around where we operate, again, we have two primary assets, EP161 and EP136. Both of these assets are focused right in the core Beadaloo. You can see the map on the right. This core Beadaloo area is really characterized by being in the deepest, the highest pressure and the highest quality shale areas in this whole basin. And so this is why we really like it, is because this area of the basin really has the potential to really produce the first development in the basin. This is where, again, you're seeing a lot of activity. Over the next 3 to 6 months, big companies have taken positions right in the core Beadaloo. Origin, right to the southwest of our EP136 block, is actively drilling right now a well called the 76S2 well. And then right to the north east of our EP136 block are two big horizontal wells that are being drilled by our partner Santos, in which we're a 25% interest holder in, called Tamboran 2H and 3H. We anticipate getting results from both of these wells in the next 90 days. So a lot of catalysts, and really each of these wells, I think, is going to provide line of sight around early commercialization plans on our EP136 block. If you go to the next slide. Again, a little bit more color around each of our key assets. Again, 31 TCF combined between EP161 and EP136. And the thing I'd like to stress is, over $100 million is going in the ground, and flow tests expected in the next 90 days. You can see the 76S2, one well right to the southwest of our EP136 block, where we have 100% working interest. And then two big wells being drilled by Santos, in which we have a 25% working interest, and really sets up a very exciting next 90 days. And it really gives us the opportunity to absorb these learnings and drill our first well on EP136 called Maverick 1 early next year. If you go to the next slide. If you look at a cross-section of the core Beadaloo, again, just to underscore, this is the deepest part of the basin. It's where the shale play, the main shale play here in the Beadaloo, called the Mid-Valkyrie Shale, is the deepest. It's where the depths of the Mid-Valkyrie is 2,000 to 3,000 meters. This is an area, in adopting some of the learnings that we've seen in North America. This is in the depth center, in this deepest areas, where you see the shale, obviously very high pressure and very rich reservoir qualities, which are all the right ingredients that you need to demonstrate very high productivity wells. And you can see our Maverick 1 right in the middle of the action over the next 3 to 6 months. If you go to the next slide. Again, we plan to be the most active driller in the Beadaloo over the next 12 months. We're participating in two wells as we speak. Tamboran 2H has already been drilled. Tamboran 3 is currently drilling and is planned to be completed in the next 30 days. The Origin well, as I mentioned before, is already drilling to the southwest of us. And with success of these three wells, it really puts us in a great position, being in the center of the activity, to get really active and drill our first well called Maverick 1 in early part of 2022. If you go to the next slide. So our business plan really is a two-phase business plan. Phase 1, as I've just described, is 3 horizontal wells that we're planning to drill in the core Beadaloo. The objective of these 3 wells is to confirm commerciality And then subject to confirming that commerciality, we'll be moving rapidly to phase 2, where we want to come back on our EP 136 block again that we own 100% working interest in, and drill 3 additional horizontals. And we look to be at the end of that program in phase 2 to look at a sanction of a pilot development, and we'd look to book 2P reserves of up to 2 TCF. And again, that positions us to develop in the core Beadaloo as early as 2025. And where we look to supply the Southeast Australia gas market that's hovering over $10 a gigajoule as we speak. Turn to the next slide. So just to characterize kind of the results and this commerciality threshold that we're looking to get over the next 3 to 6 months with our horizontal drilling. You can see on the left part of the slide the vertical wells that have been drilled in the basin today. There's again 95% of the wells that have been drilled in the basin have been vertical wells. There's limited information that you get on commerciality from these vertical well drilling. Really where we're getting really excited is the horizontal drilling that we're seeing on our block with Santos, where we're drilling what I call a horizontal test well. This is a 1,000-meter horizontal where we penetrate into the Mid-Valkyrie B and drill basically sideways into that rich Mid-Valkyrie B section. And we're going to look at the flow test out of that full 1,000 meters of the open section. Again, these flow tests are anticipated in the next 90 days. And really, this test well will guide the development well that we'll look to employ in Maverick 1H. The horizontal wells, again, is the key information that's required in any early stage basin around commerciality. If you go to the next slide, just to finish up. Upon success, one of the key advantages to our company is we have a partnership with Gemini. And this partnership with Gemini really is to work with Gemini in accessing the Northern Gas Pipeline, again, the only pipeline connecting the Beadaloo to the Southeast Australia gas market. And so we'll be leveraging that JV as it relates to delivery of first gas as early as 2025. If you go to the last slide, just in summary, just to wrap up, again, 4 key elements of any successful, next generation energy company. 1, you have to have a great strategy. We think our commitment to net zero is a winning strategy, especially as it relates to, the world consuming clean forms of energy. Have to have great assets. We think our assets centered in the core Beadaloo are the best assets in the basin. Have to have a great commercialization strategy. Our strategy, again, focused on accelerated commercialization with Gemini, I think is a winning strategy. And then 3rd, you have to have the right experience. And I think our board and management, with our experience from North America and shale, really position the company to be, one of the more exciting energy companies here in onshore Australia over the next 3 to 5 years.
Thanks, Joel. Time for some questions. We've got quite a few. The government, the Australian government has spoken about the Beadaloo Basin as being a strategic asset, if you like, and it has made government grants to some companies previously. Is this an avenue for Tamboran?
Yeah, absolutely. It's publicly known. We've applied for up to 3 grants with the government scheme, and we're hoping to have response on those and hopefully acceptance on those 3 grants in the next few weeks. So we're very excited to participate in that program. Yeah.
And Joel, you've got a zero emissions target. Does that mean the company becomes more attractive for investors that don't normally look at oil and gas and coal, for example? If you have this emissions target of being zero, does that open you up to be more attractive to institutional investors?
Yeah, 100%. 100%. Look, this is, it's a key theme sort of shifting through our industry at the moment around net zero. You have, buyers in Japan. There's 15 LNG buyers that have committed to only buying net zero LNG cargoes by 2050. So we're on, as a company, we recognize the shift and this transition that the world is ongoing around consuming cleaner forms of energy, and we're adapting. And I think that's a key differentiator to our company versus our peers, is that because of the low CO2 element in our gas that we'll be producing in the Beadaloo, it gives us a cost-effective way to offset that gas. And to your point, that makes us very attractive for new investment coming in the company and accelerating the commercialization. And that is, as any early stage company, capital, obviously access to capital is a key piece to it. And so our commitment to net zero, I think, really facilitates the future capitalization of our company moving forward.
And there's some quite a few questions here. So where do you think natural gas prices should stabilise post the winter season and Nord Stream 2 going online?
Look, I'm not one to project what gas prices might look like in Europe. I think they have a big problem. There's no doubt with lack of supply of new gas in that region of the world. I give credit to the Australian government around trying to be proactive so that we don't end up in a situation like the UK and Europe where there is a gas crisis. And this is where the Australian government has been very proactive in stimulating activity in the Beadaloo so that producing new gas supplies out of this basin don't end up in a situation where you're dealing with gas prices of $10, $20 a gigajoule. The one thing I want to underscore is that the development that we're anticipating in EP 136, our Maverick pilot development, we're looking at producing gas into the market at $5, $6 a gigajoule. So really, we see this aligning with what the government wants is to bring prices of gas down by stimulating new gas supplies, particularly gas supplies that are low on the development cost curve relative, more high cost options in and around the market today, and even looking at LNG imports, from Middle East and Russia, who are linked to very high gas markets around the world. So we look at ourselves as being part of the solution. And I can't. But come back to your question, I can't project what gas prices will be, but I do know that our commitment to developing low cost, low carbon gas resources is the answer.
And in that regard, there's a question here. Methane emissions in Queensland coal seam gas wells and water ponds is becoming a major issue. Can you avoid these problems altogether?
Yeah, look, CSG is very different than shale. Yeah, it's different in a lot of different ways. There's a tremendous amount of water involved when you're, dewatering a coal seam gas well. I know there's a lot of familiarity with that CSG in the Australian investment community because of all the development that's happened today. But the thing I want to underscore is this is very different in shale from CSG. But one of the elements is the amount of water required is a lot less. As far as the methane is concerned, look, methane is a key element to the gas stream. Our job is to not let any of the methane go into the atmosphere. And so, with our strategy around ESG, we're very mindful of ensuring that there's no methane emission and that we take the CO2 out of the gas stream. And, that provides a net zero energy solution. So, again, I just want to make the point, we are very different than CSG. This is shale, and also the economics work a lot differently. So there's, you get the gas a lot quicker in gas wells that will be drilling versus CSG. So it's not only less water intensive, but it's also higher value per well.
Thanks, Charles. We've got time for two more. What do you think about the recent results from Falcon? I think they're a Canadian company, Falcon Oil and Gas, who are out in the Beadaloo Basin. Does that get you excited, those numbers?
Yeah, absolutely. Absolutely. And it's a well that I think you're referencing that was drilled back in 2016 called Amungi Northwest 1. That well did have some mechanical difficulties in the horizontal section, but what Origin and Falcon have been able to do through running a PLT log in the well is demonstrate, back to one of my slides around the horizontal test well, that when you look at the testing of a couple hundred meters of section within that well, it demonstrates out of 1,000 meter horizontal, you could see over million cubic feet a day, and that's well above the commercial threshold that we're anticipating in the core Beadaloo. So, given that result, this is very positive for the basin. The one thing I will say is, the industry needs to be able to drill, the full 1,000 meters. That's what we're doing with Santos now with the Tamboran 2H and 3H, and then that's really where it swings to our experience, where drilling long horizontal wells is right in our skill set and in our DNA as a company with our board management on effectively drilling horizontal wells from our experience in the U.S.
Great, Joel. That's all we have time for. I really appreciate your time, and enjoy your weekend.
Yeah, thanks very much, Tim.
Next up, we have Impact Minerals, ASX code IPT, market cap of around $30 million, 1 year return of minus 34%. The company is a project generator and developer which explores a portfolio of tenement holdings with major mining regions within major mining regions of Australia. Mike, over to you. We have Mike Jones, the Managing Director. G'day, Mike.
Yeah, thanks, guys, and great to be here on ShareCafe. So look, Impact Minerals, we are a grassroots explorer. We're looking for the big win, trying to find perhaps something like the next Julimar that Chalice Mining has discovered in the last 18 months, 2 years, and that's been a 100-bagger almost from there. And that's really what we set about to do with Impact. And we've got 4 main projects, 2 in the eastern states, Broken Hill and Commonwealth, and 2 in WA. And we'll just give you a brief overview mainly of the Broken Hill, followed by the WA projects, which is where we're headed. So next slide, thanks. So one of the things that we have done over the years is that we've accumulated very large ground holdings in very prospective parts of Australia. And so in Broken Hill, and then also in the Commonwealth project, which is the Lachlan Fold Belt, these are 2 very well-known areas, very well mineralised, and we're amongst the largest ground holders in both of those areas. And the philosophy is fairly simple, that if you've got the hard work's already been done, you're already in a very prospective area, and you just need time and money to be able to get to a discovery. And so at Broken Hill, we've got an emerging nickel copper PGE discovery that we drilled in 2020. We've been a little bit set back this year because of COVID there, but we'll certainly be following up there in 2022. We've got a significant drill program hopefully lined up for Q4, which we've just ended today, so between now and Christmas, on our WA project at Dunia. And we've got some really exciting news starting to emerge from our Arkan project, again here in WA, which is in the same province as the Julimar discovery of Chalice Mining. And for our other projects, because we do have such a large ground holding, we are in the process of rationalising our holdings. We've done a couple of small deals which we've announced, and we're in discussions with a number of parties on some of that, some of the large ground holdings that we've got in the eastern states. So next. A little bit about Impact. So we've been listed since 2006. We have virtually exactly 2 billion shares on issue, and current market cap, as I said, around about sort of 30 million at share price of 1.5 cents. We're sitting on a good amount of cash, probably 3 million at the moment, and that should be good enough to get us to the end of the Dunia drill program. And we've always had strong support the last sort of 10 years from various German shareholders. We've got a family office, the Bonenbergs, out of Dusseldorf. They're one of Germany's wealthiest families, and they own about 10% of us. And then ABC is a subsidiary of Deutsche Balaton, which is a significant investor in a number of emerging developers and producers in the Australian market. So all in all, in a good position, and we'll see the share price. We have suffered in the last few months. We had a drill program on our Commonwealth project for copper gold. That didn't come in as what we were hoping, and so shares have drifted down, but I think we've seen a significant turnaround, as we can see in the last few weeks, as we've announced our Arkan soil results, both for nickel copper PGE and also lithium cesium tantalum. Next. So Broken Hill, this is where we are. This is what it looks like. This is one of the prospects we drilled last year. Next. And this is our ground holding shown here in red. There's a scale bar down there, 10 kilometres. And so we've accumulated a significant amount of ground there, but our main focus is on the right-hand side of that diagram, running from Morkai in the top right, Platinum Springs, down to Little Broken Hill Gabbro in the centre. And there's a 40-kilometre belt there that's been well known for many years to have very high-grade nickel copper PGEs, but not just palladium and platinum, which are the most well-known ones. It's also got exceptional grades of osmium, iridium, ruthenium, and rhodium, which are the other four as part of the 6 metals in the PGE group. And you can count on the fingers of one hand where you get those kind of grades around the world. And so there's something very unusual, special about this area. Next. And how unusual it is shown in this slide here. This is a picture of some of the drill core from a few years ago that we drilled, following up a high-grade intercept from probably 30 years previously. And we intersected this beautiful massive sulfide, and looked at the grades here are exceptional. It's 0.6 meters, basically an ounce of platinum and palladium together. It's got 1.5 grams of gold. It's got 15% copper and nickel combined, 1.5 ounces of silver. It's got cobalt. And here we've got sort of 1 to 2 grams each of the rhodium, iridium, osmium, and ruthenium, all close to surface. And it's probably the richest ore in Australia if we can find more of it. And the map on the left there shows basically a 9-kilometre long trend, which is dripping in PGEs. And Platinum Springs, which is where this is from, is at the southern end. And it's the only place that's been drilled in over 40 years of exploration. And the question is then how to focus in that area. So next. So one of the issues of platinum group exploration is that they're very fine-grained, and so you can't see them. In North America, they call them no-seeing zones, and you can't detect them directly with a handheld XRF, which a lot of people now use on a drill program. And so you normally have to send it to the lab, and it just causes long delays in your drill programs. And so there's an example here, very boring looking rock from one of the world's significant palladium mines in Lac des Iles, and it's running 18 grams, and you wouldn't have a clue unless you sent it to the lab. Next. So in 2020, though, we made a massive breakthrough for PGE exploration, I would say certainly in Australia and possibly globally, is that we did some significant machine learning work and discovered basically a ratio that we could measure with our handheld instrument as the drilling is occurring, which is directly related to the platinum, palladium, and gold grade, 3 PGE as we call it. And that's shown here in this slide. And these are from assays, chemical assays. And we've proven to ourselves that our handheld XRF will give the same result using a ratio of all of these different elements that we've worked out related to the grade. Next. Now that was an absolute breakthrough, because what that meant was that we could actually direct the drilling as the program was going, rather than having to wait for laboratory assays. And I won't go into detail here, but basically we moved the drill rig along this particular cross section, and the host unit is shown in purple. And we move the drill rig backwards and forwards using our ratio to sort of try and ping the highest grade areas. And hole 30 in the middle there shows a meter at 3.3% nickel, 1% copper, and 22 grams PGEs from our laboratory results. And that was found exclusively with our ratio. This is an unbelievable breakthrough for us, and it's certainly changed our entire approach to the exploration at Broken Hill. And we were able to define, and shown in red there, the sort of channel-like structure, which is host to the mineralization. And it's this type of geometry that is the host to significant nickel and copper at places like Kambalda. And so our challenge now is to track that channel along trend, and that'll be the focus of our next drill program. And there's 9 kilometers along trend that have never been drilled before, and all carrying this high-grade material. So we think there's a huge potential to find a number of those channels when we get drilling there again. Next. And the other area is Little Broken Hill Gabbro. We were the first people ever to drill here. It's a unit that's about 6.5, 7 kilometers long. And to summarize, every drill hole that we put into the basal part of this unit was carrying very high grade and very thick widths of modest grade PGE with some lower, thinner intercepts with higher grade. So there's 60 meters at sort of 0.3, 0.4 PGEs, and then a meter at 2.3 and 8 meters at 1.3. So this is trying to form one of those channels at the base of this unit, like we've seen at Platinum Springs. And we think that with a lot more drilling, we've got a real chance of finding a major ore body at the base of this Little Broken Hill Gabbro. But look, because of COVID, things have been closed down across New South Wales for the last few months, and so we haven't been able to get back there as we would hoped. But we're certainly looking to be there in the first and second quarters of next year. Next. So what we've been doing is that we basically pivoted back to WA, and the middle of last year, on the back of the Julimar discovery by Chalice, and that discovery led to basically a tenement rush up and down the Perth, north and south of Perth. But we were able to acquire quite a significant ground holding, 100% ourselves, out in the about 150 kilometres east of Perth. And the day that we announced that we had got this project, Anglo American Corporation, one of the world's top 10 mining companies, staked all around us, an area of about 10,000 square kilometres. So huge outcome. So obviously we just picked them to the post, and they decided to act afterwards. And it's a pretty exciting area all through this southwest of WA. It's very poorly explored. And just press next, another little image will come up. Yeah. And so there's many magnetic anomalies all through our ground and probably throughout the southwest. Our bow target is shown there on the left. And for size comparison, we've got Julimar for Chalice on the left, and most of the mineralisation is found in the little oval anomaly in the centre there. And a new line was recently drilled by Mandrake, also out in that area. And these are all little mafic, ultramafic intrusions with the potential to host significant PGM deposits. So that's really what our focus was. Next. And so we identified 17 targets from our own target generation technology. And we announced only a couple of weeks ago the results of the first sort of past soil sampling over this area. Now, remember, this area has never been drilled. There's some regional soils done before, but no detailed work ever. It's completely unexplored. And we were able to identify out of our initial, 15 targets, we got 6 priority targets shown there in red outlines, and then another 4 of medium priority. So it was an incredible outcome for us, very exciting. Examples on the on the right-hand side there, significant nickel, copper, and then palladium, platinum, and gold together. So it's the fact that it's got those precious metals indicates to us that it is not just raised backgrounds from, say, mafic or ultramafic rocks that aren't carrying any mineralisation. These have all got significant palladium and platinum and gold results associated with them. So first time ever done, and all we've done is roadside traverses. We are in negotiations with land access with the farmers to get in there. Harvest will be finished in a month or so. And so by the end of this quarter, we should be back on the ground there and be able to get the next round of work done. Next. And but we've got a nice surprise out of that. As we were doing the soil sampling, we've actually come back with some very significant lithium, cesium, tantalum anomalies. And this isn't surprising. We've got this project covers 2,000 square kilometres. It's in an area that's well known for its lithium. We've got, another 6 priority targets, and we'll probably have some geophysics going over a couple of those in the next couple of weeks. And that was really sort of, put a bit of a light underneath our share price. And I'm pretty confident we're going to get some excellent results and some drill targets for next year out of our next round of work at this project. Last couple of slides. What we're aiming to do before the end of the year is to drill our Dunia gold project. Now, this lies about 25 kilometres east of the recent Burns discovery by Lefroy. Very unusual discovery. It's copper gold, and it's got magnetite associated with it. And this is very unusual for this part of the world. The gold fields there, one of the world's great gold producing terrains. They generally don't have copper, and they generally don't have magnetite associated with them. So it's a new style. And next, and our Dunia target, very similar in terms of the chemistry that we've discovered there. And it has this sort of little magnetic anomalies. You can see the scale there, 2.5 kilometres. And there's a very significant gold and bismuth anomaly over the top. Never been drilled at depth, and we'll have a major program, 3,000 metres to start there as soon as we've got our rig lined up. But we hope to be up and running by November this year. And that's really the impact story. So last slide. So look, we'll be drilling in this quarter, moving through the drilling in Broken Hill. We've got our follow-up work at Arkin to come, and we've got a significant rationalisation program in process at the moment for our eastern states, the remainder of our eastern states projects. And so, I think we've got a really good chance of delivering the goods over the next 6 to 12 months. So keep your eye on us, and thanks for listening.
Thanks, Mike. Thanks for your time. Just on that slide there, that Claremont 1 million shares in AHG, what is that potentially an asset you will look to sell down?
Well, look, obviously we've done quite well out of it. The million shares was done at 10 cents in the pre-IPO, but we're escrowed until May next year. So obviously they've gone for a run.
Where are they trading? Sorry.
Well, they were up about 35-40 cents. I think
Right,
they're part of the. I think they're part of the. Some of the meme stocks that we're going because it's tightly held. But I know the MD personally. He's a really great guy, and they're doing a very good job there. And then there's a float coming, Orange Minerals, and we've sold a couple of small tenements into that float, and they should be listed in November. And most of that's in cash, as you can see. So it's a good start to the process.
And I suppose the question is how do you focus on your best priority? There's talk is it WA nickel or is it your Broken Hill project there as well?
Yeah, look, we're in the position that we've been able to pivot because we can't actually access Broken. I mean, even Broken Hill was in lockdown.
Yeah.
So we just couldn't get the guys out there, and it's all still up in the air. So it's just like, no, we'll just put it on hold. We know where we need to do the work at Broken Hill. The drill program's sitting there. So in the meantime, we need to get, Dunia drilled. It's just a very simple one-off walk-up target. Is it there or is it not? And so in the pipeline of targets, then Arkan is the real key. We are really astounded by the results we've got from that work, and I'm pretty confident we're going to, do very well there over the next 12 months.
You're obviously very nimble, given you've picked up that tenement out near Chalice and Anglo, was it? How does that happen, that process, and how did you move so quickly?
Yeah, well, we were probably the first of the latecomers, for want of a better term, and I think most people have been focused north and south of Judimar because that particular part of the geology is where most people think about where the nickel copper occurs. But many years ago, I'd actually identified a structure in the magnetics, which was at a high angle to that, which is probably of similar nature. And then lo and behold, somebody came to us and said, "Oh, look, there's a few sniffs here. Do you want to peg it? And we'll give you a few shekels." And that's what we did. But obviously, Anglo had been thinking about acting. And then when we jumped that piece of ground, it was like, oh, we better act now, otherwise we're going to miss out completely. So. And Anglo's discovery manager, who's managing the project, was his first job was at Impact Minerals 16 years ago. So
there you go. And how do you prioritize your allocation of capital, given you've got a great expanse of potential assets here?
Yeah, but there's a lot of management of that portfolio in terms of minimum expenditures, obviously, whilst really sort of focusing on the highest priority ones. So whilst we've got a large number of projects, we're very focused on gold, silver, nickel, copper, PGEs. It's just that they occur in different geological environments. And so we just rank them like we would as if we were just a gold-only company, and we pick them off as we go. So the idea is to get as much money into the ground in drilling, and so that's why Dunia then has been able to come to the fore, and it's been sitting there for about 12 months. It's now ready to go, and we'll hit that. And by the time that's finished, we should have other drill targets at Arkan, and then obviously as soon as we can get back to Broken Hill in the new year, we'll be drilling there as well. So I think next year we're going to see a lot of meters drilled for Impact.
Great, Mike. That's all we have time for. Nice to hear the Impact story, and love to hear it again, perhaps later in the year.
Okay.
Thanks, Mike. Have a good weekend. Next up, we have Vmoto, ASX code VMT, market cap around $150 million, 1 year return of minus 18%. The company aims to supply the next generation EV scooters that are sustainable, smart, and environmentally friendly to modern commuters and travellers. Have a look at their website, which I did prior to the presentation, and you'll see a very cool video on their scooter range. We have with us Blair Sargent, who is one of the non-executive directors. Blair, over to you, mate.
Yeah, thanks, Tim. Appreciate the invite. Okay, so Vmoto, if you can just skip to the third slide there, but we're an Aussie incorporated and ASX listed here, but we are truly global. Certainly operate all around the world, and I'll talk to that in a bit more detail. But in essence, we concentrate on the manufacture, distribution, sales, marketing of two-wheeled electric vehicles. And by that, we're referring to mopeds, so Vespa looking like bikes, as well as motorbikes. So no kick scooters, but just those two particular streams. We own our own manufacturing facility in Nanjing in China, which is over 30,000 square meters. State-of-the-art manufacturing facility, which we've owned since 2007, 2008. And the idea in really simple terms is to combine European design and flair and branding with low-cost Chinese manufacturing base. And that certainly created a wonderful platform in which to ensure long-term sustainability and competitiveness. Next slide. 3 brands in essence. So Vmoto being one, obviously, Super Soco, second one. So that's not brand, but we operate under a manufacturing JV, and combined with Vmoto retaining the distribution and marketing rights to that brand for all of the markets outside of China. And then the third brand being the Emax brand. And just as a matter of interest, that was the first electric scooter that Vmoto ever produced, which was in 2009. So certainly enjoying a bit of a first mover advantage in that regard. Okay, next. Distribution. As I mentioned, we are truly global. So the corporate head office is based in West Perth. As I mentioned before, we're listed here. We've got the manufacturing plant that's based in China, and that's all about a low-cost manufacturing base. And then our distribution basically is global, with the great majority of our business actually being generated in Europe. Next slide. Okay, so the manufacturing facility, as I mentioned, we committed to that. It was back in approximately 2008, 2009. And it was certainly one of the smarter things that we did. So we bought the land first and then built the building. As I mentioned before, it's over 30,000 square meters. It's wholly owned by us. There's no debt attached to it whatsoever. Importantly, you can't just manufacture scooters, electric scooters in China if you feel like it. You must have government sanctioned license. They're not easy to get. So that in itself is also of significant value. We have ample capacity to support over 10 times the current production volume. So in terms of growth, we're well positioned. And as a matter of interest, we're only carrying it at $5 odd million, which basically reflected our cost. But back in 2009, it's been valued at 12. It's probably closer to $20 million now, and that's without assigning any value to the actual license itself. So really well positioned, as I mentioned, both from a cost perspective, but also from a growth perspective. Okay, next slide. Actually, if you skip to the next one. So I'm just going to talk now about what this all means in terms of the hard numbers. So we've just released our half-yearly results. And as you can see there, revenue of 39 million for the half, which is up 50% compared to the previous period. Net profit after tax of 4 million, up 119%. EBITDA 5.4 million, also up 100%. Operating cash flows were good at approximately 1.7 million. We've got over 16.7 million cash on the balance sheet as of 30th of June, and NTA of over $39 million. So in all categories, we're up, and we're up significantly, particularly on the net profit after tax, which of course is the most important part. Next slide. Okay, and just translating some of that into some numbers. So 13,000 units sold for the half, which is up 30 odd percent. As you can see there, also the great majority of those units sold internationally. So in essence, Vmoto does not sell product into China. That's not our game. We're definitely a global player. And although the market is massive in China, it's also unbelievably competitive. So it's not a place for us to be. We care not to be there. We want to concentrate on those international markets, which are certainly capable of generating the profits that we're after. Distribution network. So again, as I said, we're global, but what does that actually mean in numbers? Over 53 international distributors in over 60 countries. So we certainly covered the great majority of the world. North America is probably one market that we haven't spent too much time in yet, but we're certainly looking to grow into that area soon. The bulk of the business, as a matter of interest, is not selling scooters to individual consumers. It's actually to other businesses that are using our electric scooters and motorbikes for the purposes of A, last mile delivery, and B, ride sharing. And by ride sharing, I'm not talking about Uber. What I'm talking about is a fleet of scooters that are available for people to go and utilize, on an as and when basis. That particular market is huge in Europe. It's starting to gain an enormous amount of traction in North America as well. And that's where a lot of the growth is coming from. Having said that, the last mile delivery segment, so we are talking about Uber Eats, Menulog, DoorDash, KFC, DHL, any of those brands, anything involving the delivery of parcels and or food for the last mile is also a massive growth market for us. And that continues to grow. And we're sort of looking forward to that continuing as we move forward, particularly in an environment where net zero emissions, which has been talked about quite a bit, and the world going carbon neutral as soon as they can, that necessarily relies on the electrification of the transport industry. So we're at the forefront in the effective. Lots of opportunities out there. We are fielding inquiries on an absolutely basis. I participated in a conference call last night with India. India is in fact the largest scooter market. It's bigger than China. So there's some wonderful opportunities out there. Next slide. Balance sheet. So I won't bore you too much with this. Needless to say, though, as I mentioned, 39 million approximately in net assets. So we are really well placed. No debt. We paid that off recently, approximately about a year ago. And it's underpinned by cash, receivables, but also, as I mentioned, the manufacturing facility itself, which carrying value being 5, but it's probably worth over 4 times that. So we are absolutely well placed to enjoy some growth moving forward. Next. So disappointingly, our market cap's only 115 million. I say that in relation to performance, which I think both the managing director and the CFO should be congratulated for. I mean, it's outstanding with growth rates of approximately 100% across the board in essence. So the numbers that we talked about before were only half-year numbers. So we're on track for realised revenue of approximately $80 million and a net profit after tax of circa $8 million. So we're being priced as an income stock when we're quite clearly a growth stock. So a little bit different, but you can see there how it looks. The top 20, over 52% of the register, and probably worth noting that the single biggest shareholder is the company's managing director. So absolutely perfect alignment between management and shareholders in terms of where we want to see the share price going. Okay, next. So as you can imagine, the outlook is pretty good. We're expecting to continue to enjoy the growth rates that we have over the first half. And as I'm sure you guys will appreciate, or the listeners will appreciate, that the world is going net zero by 2050. That's the goal. As I mentioned, the transport industry is one of the biggest emitters, and therefore the electrification of that industry is absolutely paramount. And Vmoto were one of the first movers into that market back in 2009, and we are absolutely well placed to continue to grow at the rates that we've currently been going at. And the future does look really bright, and I think we deserve some more attention. We're looking forward to not only the next 6 months, but the next 4 to 5 years is pretty exciting times, I think, for the company. And that's it. Thank you.
Thanks, Blair. I think this is a fascinating story, actually, and I think it is off the radar of investors. Can you? I've got a lot of questions here. Are the current problems with global supply chains affecting your production rates?
Not affecting production, but definitely affecting distribution. It is chaos out there. I don't think most of the sort of market understands how bad it is. But to give you an idea, a typical 20-foot container from Shanghai to Europe was costing about €3,000, and now it's €18,000. I mean, it's absolutely extraordinary. So it is chaos. So it's certainly impacting our ability to distribute, but it's not impacting our ability in terms of production. And that's because all of the suppliers are actually all based in China already. So that's not really an issue. We do expect it to normalise. It's just going to take a little bit of time, I think.
I mean, there is a question on that. If you could talk to your access to key input materials, components, microchips, rare earths, lithium, it's all becoming increasingly a key to manufacturing and marketing sustainability. Can you comment on your kind of supply chain arrangements?
Yeah, so I think, look, in any given electric scooter, essentially the three key components are the battery, the motor, and the controller itself. So most of the motors that we use are Bosch, so from the large German conglomerate, so no issues there. In terms of batteries, the key suppliers are all the names that the market probably already understands. So we're talking about LG, Samsung, Panasonic, and ATL. ATL being the battery you find in an iPhone. So they are the biggest companies in the world that are manufacturing the batteries on our behalf, and the controllers are locally made. The only other key component is the IoT device, which is not always installed, but that's the key device which makes the scooter smart, which is very important, certainly for ride sharing and for last mile delivery as well. But I think, I guess the point really is that you've already seen a lot of those major manufacturers of particularly the batteries starting to engage directly with producers of some of those key materials. So LG signing up, directly with a mining operation for lithium, and you've seen Tesla doing exactly the same thing for nickel. So it's not for us to do it. We're certainly relying on our main suppliers to take care of that, but I think it's fair to say that they're well and truly onto it. And they're certainly we're not suffering any delays as a consequence of lack of raw materials going into our major suppliers. So as it stands, we're all good, notwithstanding that we're probably going to install 25,000 batteries this year. We're comfortable, not suffering any delays, but we are relying on those key suppliers to take care of their own business in terms of underlying supply of raw materials.
And EV battery transport forms of transport have been known to be more expensive than the traditional user. Well, how does your pricing compare to competitors? So if you go into pitch to one of those large buyers, how does that stack up?
Well, I think the answer is that like cars, electric scooters are more expensive than their combustible engine counterparts. But the cold hard reality is, as I mentioned, Europe is our biggest market. And the market is not interested in using combustible engines. So at the end of the day, they are only looking to source electric vehicles for the businesses in which they're rolling out. So it's just not an issue for us. As long as we're competitive within the EV space, that's the only thing that matters. I think it's fair to say that combustible engines are dead. When I say they're dead, I mean, obviously still it's a massive market out there, but everybody is switching to electric. So these new business models that are being driven by smart electric scooters that are relying on the interaction of the consumer, their mobile phone to unlock the bike, to identify themselves, and all of those things are simply pointing to the use of electric only, not combustible engines. So the fact that they are a little bit more expensive, it's a non-issue. To sort of just be a little bit more specific, in Australia, the retail price of an electric moped that we sell is had under $5,000, and you could probably go and buy a combustible engine version for $500,000. That's just not where the market's going, so we're not really worried about that.
Understood. And a number of questions here around who are your key competitors?
There's a couple. There's a German manufacturer by the name of Govex, which are doing very well within Europe. In fact, they're probably the number one player in Europe in terms of EVs from a moped perspective. And the other major competitor that we see is a company called New, which is a Chinese-based company, but is listed on the NASDAQ. Market cap is about 2 billion. We actually outsell them internationally as a matter of interest. They do 380,000 units though in China, which is not actually big in the Chinese sense, but they are the most active in the space in which we're operating. So as I mentioned, they're more focused on the ride sharing aspect. Our focus really is last mile delivery. But I would say that those two companies in particular would be our major, competitors. All of the big brands, which some of the listeners are probably keen to understand, I think you can expect them to start producing and marketing electric scooters, but there's a real reluctance to do it at the moment, and that's to do with their upsetting their traditional distribution networks. So when Honda and Vespa and the rest of them start marketing these things globally, I don't know when. I think it's inevitable, but they're certainly focused also on the consumer market, not in the markets that we're focused on. So again, I think we've got the first mover advantage. It's working well at the moment. Our growth rates are fantastic. We don't expect that to stop anytime soon. And I think in the end, if we focus on those particular markets, we'll be fine, even when the big boys do arrive.
And Blair, just quickly, what's the revenue breakdown in terms of geography?
I don't know what it is exactly, but I would say the great majority, without a doubt, is Europe. We've not really targeted the US yet. We're in discussions with a couple of companies in that particular market. And then, as I also mentioned, for us, India has the potential to dwarf the rest of the world in terms of their requirements. From a government perspective, they've already decided that they're going electric. So that's gaining momentum. But I think the short answer is, I would estimate circa 70% is probably Europe for us.
Great. Thanks, Blair. We still have a number of questions. I'll shoot those through to you. If you could get back to those investors, that'd be great. Thanks for your time.
No
It's
problem.
a fascinating story and probably one the market doesn't understand very well. So thanks again.
Good on you. Thanks, Tim.
That's all we have time for, everyone. Enjoy your lockdown weekend, hopefully one of the last, and we'll see you next week.